Okay, folks, we are having a camera error. What's going on here? Let's try this again. My apologies. Gonna fire my producer. All right, let's see what's happening here. That'll do. That'll do. Okay. Welcome. Welcome to the most important, financial podcast. I don't know, on YouTube. Let's say hello to folks. Jody, welcome. Franklin, welcome. Yeah, yeah. Direction's a great word. I mean, this market looks like it wants to go up, and we can't rule out that it will go up. We're in the same position that we were in this time last week. We'll go over valuation in a moment, but we're above that 2020 high, 2021 high. But usually by Friday end of business, we sell off and we don't close above it. Is this the third time, fourth time the charm? We don't know. Uh, I've been putting on. I've been trying to be as balanced as possible. Balanced in terms of when I put on a trade, it's probably more skewed short, but trying to keep a balance. Uh, Case in point, MIDD. I'm not sharing my screen. Let me share my screen. Where am I sharing my screen? Stop screen sharing. What's going on here? Okay, that's better. Lots of technical glitches today. All right, so case in point, my job is to worry. That's what I do. I worry about risk. And do I have too many coins or too many apples in one barrel? And that could be arguably so in many different ways. But in relation to the equity markets, I do not want to be overweight equities right now. I want to be balanced with a skew to the short side, like MIDD. We opened up a call spread here earlier. I guess today we got filled on it. And I put in a wish list order and I got filled. It took a while to get filled, but we got filled and it backed right off the highs of the day. So this stock here is a classic contrarian trade, meaning to the typical eye of a non-contrarian, they're looking at this stock like, oh my God, it's only going to go straight to the moon. Okay. Another way to look at it is that this is unsustainable. So I sold the call spread into this rally, and now we are short, but not of the common stock. We're short up at the 190 strike on the calls. So what we did is we sold premium. We generated cash flow, and to my eyes, this is topping action, and I think that we probably break to the downside on this stock, and we collect our premium, and we live to play another day. We go find something else to do, and we're just constantly rolling our positions, generating daily cash flow. Uh, Another one, Starbucks. We sold a call spread here pretty aggressively, and we're short technically, but not of the common stock, of the call options. I think that we're going to pull back here, and we're going to collect that premium, close it out, and live to play another day, find other opportunities. That's the way I'm trading the market. Now, we did open a position today on Meta, and some people can't admit when they make a mistake. Me, I consider it a honor to do so, because it's what keeps you humble. You learn from your mistakes. And I opened up initially an iron condor, which is a simultaneous sale of a call spread and a put spread. But I made the deltas on the call strike way too close to the money. And I closed out that spread. As soon as I realized what I did, I closed out the put side. So technically right now we're short of Meta, and I'm going to be looking to open up a put spread on any pullback, and that'll be a market neutral type of trade. So it's how we're trading the market. And it's not just equities. We're very diversified into commodities. We're very heavy now into silver. Silver had a beautiful day today, broke out of a resistance level. We sold one call spread last week. And then as we broke out yesterday, I sold another tranche of a spread here. And so we are even now more long of silver. Gold today, same deal. Hit new all-time record highs. What do? We added to our long position today in gold. So we're very balanced right now in terms of diversification across asset classes. So that's what we were doing on the week. It's to sell premium. It's good. You're not staring at your screen and doing all that stuff every day. What you're doing is that you have a 50 to 45 day time horizon where you are making high probability bets and just generating cash flow, and that lets you do your day job. So what we want to do now is, after the bell, we had Apple that reported. And this is a classic case of beware the knee-jerk reaction of the market. Note when they sent this out, right on the dot, 5 p.m. This article was pre-written. And Apple slides after iPhone sales miss. China revenues unexpectedly tumble. Now, what if you would have paid attention to this article and sold your shares, or God forbid, would have gone short? Well, you wouldn't be feeling too good right now, because yes, initially the share price rolled over. Then the market started to appreciate the underlying tone of the report. And I don't know what the underlying tone is. Maybe AI related, who knows? But the street reversed it, and that's why it pays to allow for that knee-jerk reaction to dissipate and see whether or not you get a bounce back and then a continuation sell-off, or do you reverse as you did here. So Apple up in the after-hours session, and the market maker anticipated move here was $9.67. Let's just call it $10 for using math. We closed at 237.59. So premium writers like I am, I don't really trade earnings anymore. They made a lot of money here. They did very, very well. So Apple looking good going into the new trading day and the final trading day of the month. Think about it. Let's see how the NASDAQ futures are behaving. They are now open. They're moving up. Volatility pulling back, yields pulling back, but actually they're up. Yields are up, but they're off the highs of the session. So let's talk about the economic data that's come out today. You had GDP growth comes in unexpectedly light, despite red hot personal spending beating estimates. First off, the personal spending is on credit cards. That's a problem. So and it's finite. There's only a certain amount of credit that you're going to have, and eventually the banks are going to cut people off. So that allowed for gold to move up higher because it's going to be anticipated that the Federal Reserve is going to have to become more accommodative, especially in light of the president. I've been warning about this because Jay Powell and the Fed, this came out today, and the Fed failed to stop the problem they created with inflation. I will do it by unleashing American energy production, slashing regulation, blah, blah, blah. I won't read all of this. But long story short, they're at war. And they've been predicting that this is going to happen. The war of words between the Federal Reserve and the White House has begun. And the goal by the White House is to get the Federal Reserve to provide liquidity to the market, whether that be building up their balance sheet or cutting rates. Trump doesn't care. The problem is that there's a good chance that it's going to stoke the flames of inflation. Now, on the topic of let's see what the Federal Reserve did. Wow, they continue to roll off debt off their balance sheet. This is reported as of yesterday, but released today after the close. So the Federal Reserve's balance sheet, they continue to liquidate treasuries, and that is keeping yields higher because they're not buying. So Q4 GDP came in light. And what does that mean for rate cuts? March is now up to 42.9% probability of a cut. June, 79.5. I think that's down actually from last night. July is nearly 80. Now, economic data coming out tomorrow. We're going to get the PCE inflation index. That's the Federal Reserve's favorite measure of inflation. And you're going to want to watch the year-over-year numbers. That's what the Federal Reserve, he said it the other day. I listened to the replay. Jay Powell is looking at the year-over-year inflation rate to guide him on his next move. If it comes out hot, expect yields to rise. If it comes out cool, expect yields to fall, equities to rally. Valuations. So valuations, we are at I was inaccurate earlier. I need to make a correction. I stated earlier that we're above the October 2021 highs. We are not. We're just shy of it. So we'll see what tomorrow brings. But even though you have all these earnings that have been reported now, you've had the banks that have reported. A lot of the triple Q names have reported now. Apple is not factored into this, and certainly they matter. But right now, we're really not much changed from where we were at last week in terms of valuation on a rearview mirror basis. On a forward-looking basis, not quite sure where we stand. We'll do that research and we'll have that for you on Sunday night. So either way, we're very expensive, just shy of the October 2021 highs. The Buffett indicator strongly overvalued. Okay, we're beyond two standard deviations above the historical norm. So we still need to be very, very careful here. This is the proximate reason as to why we have a short bias on the market. And the other reason is this: S&P 500 short interest has fallen near its lowest level in the past 14 years. Now, a lot of people may say that's very bullish for equities. Yes, until it's not. What this implies is that the level of complacency on the part of shorts is that they're just saying it doesn't pay to be short. Jim Chanos hardly shorts anymore. Who's the guy with the white hair? Went to war with Carl Icahn. Slips my mind right now. But he doesn't short anymore. A lot of shorts, famous shorts, don't short anymore because it just hasn't worked over the past decade or so. So they've thrown in the towel, but now we're at historical lows, and that's a problem because when this gets going in the opposite direction, poop's going to hit the fan. So it's a contrarian indicator. It's one that lets you know that there's a lot of complacency on the part of shorts, and at some point in time, they're going to come back in with a roar. And one of the areas that I'm looking at as being really vulnerable, car market. U.S. new vehicle sales are slowing. U.S. new vehicle sales came in at 15.8 million in 2024, well below the pre-pandemic level. From 2015 to 2019, new vehicle sales were 7% higher than they are now. It's a big number. 2024 new vehicle sales were even lower than the 16 million recorded in 1986. Think about that. To put it into perspective, new vehicle sales were 17.4 million in 2000. The economy was closed, or 9.2% above 2024 levels, even as the U.S. population has grown by 20% since then. And I said, I'm thinking 2020. Well, the economy was not closed. So to put it in perspective, new vehicles, that's huge. That's huge. This comes as car prices remain historically high, and they are. Transaction price coming in at $46,200 in December. So a problem. And these EV sales, I mean, the depreciation on the EV products is just bizarre. And if you ever get the Chinese EV vehicles making it into the U.S. markets, they're cheap. They're like $5,000, some of them. They probably won't make it in here, but if they do, beware of the names like Tesla, because they're gonna come under a lot of pressure, pricing pressure. And the job market. U.S. job market is not strong. The average duration of unemployment in the U.S. hit 24 weeks in December, the highest in 3 years. It has never taken so long to find a new job for Americans outside of the 2020 crisis and the financial crisis aftermaths. People struggle to find a job, and I empathize. So GDP slowing. You're not getting the car sales you used to. The cure for high prices is high prices. So ultimately, these prices are going to have to come down, and that's the only thing that's going to spur new car sales. So that's the news that's fit to print. Overall, earnings this week have been okay. Somewhat soft, to be honest with you, on some numbers. I mean, Tesla's numbers came in soft. Why they were up today, I don't know. But it looks as though they want to break out. So who am I to argue? I think the only thing that's keeping Tesla up right now is the fact that you had management come out and say, we think that 2025 is going to be a good year, a resumption of growth. Okay, we'll see. Let's say hello to folks. Tim, welcome. Seymour, thank you. Wouldn't it be great? We're 22 minutes in, and I just checked to see whether my audio is good. Thank you for letting me know that, though. TZ Burton, welcome. Donnie, welcome. Great to have everybody here. Okay, let's check out the weekly charts and see how we're setting up for the end of the week and next week. And as Franklin is looking for, we want to find out right now, which direction is this market going to take? Remember, as we go over this weekly chart and we're trying to get a pulse for how the market's going to close and how we might position for the new trading week, we have one trading day left to go. And without fail, when I go over these charts again on Saturday and I send it out to members for the week ahead commentary, guaranteed there's at least one or two charts that have changed dramatically on Friday. So keep an open mind. One trading day left to go. And it's the end of the month, no less. So you may get some positioning on the part of fund managers tomorrow. Don't let them influence you too much. All right, so bullish percent index, we are putting in higher highs. We're not overly bullish on the equity markets. We're just right, to be honest with you. The CRB commodity index, potential island reversal. We're off the lows of the session, but we are down on the week. What do we do today? It looks as though we were up on the day. Yes. And that's probably because of inflationary concerns that the Federal Reserve is going to be pushed into cutting rates, even though we have a inflation problem. Yield curve is down on the week, potential double top. So this is what was really keeping me from adding more aggressively to the short side. I just want to be, again, what we call it beyond the horizon shorting, meaning selling out of the money calls, and we let time decay work for us. So that just keeps us safe. It just makes me feel good to trade this way in this type of market environment. TLT, weekly chart, up 1.28% on the week. We're long of TLT. However, it's still one of our worst performing positions, but we are getting some money back here. Let's take a look at the daily chart. I want to go back, take a look at how it's doing. Lackluster. This is not a very bullish setup. We're not seeing major gaps up here like back here, but that was a short covering rally. You want to see something like this. Rally, pull back, higher low. Rally, pull back, higher low. We don't have that yet with lethargic. Yields. We're down in the week. That's the best that could be said. Momentum is rolling over as measured by Stokes, but it's not very bearish. Let's go daily view here. We broke support today, and they tried to recapture support, and it was rejected intraday. Tips. They gapped up. They've been doing very, very nicely. These are the types of candlesticks I wish we'd see on the TLT, but we haven't. The dollar. Reversal bar. Now, this is a concern. If you're long of gold and silver, it's a concern because they usually trade inversely. Let's take a look at a daily view. And this is the ETF. So let's take a look at volume. Volume is very light. Daily view. Let's try that again. Daily view. So what I'd like to see here is a break of the dollar. We may not get that. Volume is light, but we did break out yesterday. We did a retest today. Okay. Now the euro, Polish taco. Hey brother, how you doing? Love that name. The euro. This was really odd. What happened here uh, earlier at around lunch? I was taking a look at the price of the dollar, and the dollar was up, and the euro was down. I'm sorry, the dollar was up, euro was down. And the strange part about that is that the ECB, the European Central Bank, cut rates overnight. And at the end of the day, ultimately, they sold the euro off right there. They sold it off, and then they rallied the dollar, which kind of makes sense because the ECB cut rates. But clearly there was a little bit of shenanigans going on there in the Forex market today. And I think that the euro is probably going to break lower and the dollar is probably going to move up higher. Now, oddly enough, of all currencies that may mute the rally in the dollar, it is the Japanese yen. Japanese yen weekly chart up on a percentage point on the week. On the day, it was up as well. Good price action. Bitcoin. Let's refresh this as it is trading. So a very strong week so far. Up. Okay. Up 2.5%, more than that on the week. We're just off the highs of the week. Looks as though we're moving up higher on Bitcoin. Volume, light. Daily chart. We are attempting to close above resistance. If we do, if it's successful, probably new all-time highs on Bitcoin very soon. Volatility. Now, at lunch, when I was looking, volatility was down. By the end of business, it was up. We're up on the week. Down on the day. But we did rally off the lows of the session. But we did close down below the 50 and 200-day moving averages. We need to give the odds to bulls right now, especially with Apple trading up in the after-hours session. The Dow transports. Reversal day. Closed down on the day. While on the week, I'm sorry, the week. Let's see how it traded on the day. Yeah, gap down today. That's not good. Big volume. Dow Jones Industrial Average, weekly chart. Looks as though we are going to break out to new all-time highs. Very, very powerful chart here. The only fly in the ointment, you want to see the Dow transports confirm it, but they're not. That's the Dow theory. Daily chart. We've stalled out here a little bit. The test is always at the top. You have a lot of trepidation right at the new all-time high level, so you got to give it a pass. But man, if we clear and close above 45,100, we're going a lot higher very, very quickly. S&P 500 weekly view down on the week, but we reversed off the lows. Let's go daily view. Daily view consolidation. Volume light. Let's see how they close this out on the day. 30-minute view. Not a great close. That's been a consistent theme of late. Usually get some buying into the close in a healthy market. Lately, we've been seeing selling into the close. Qs, weekly view. Reversal bar on the week was still down though, 1.24%, but we were off the lows. Daily view. Trying to break out, and we probably will. Volume, very, very light. Let's check out the 30-minute view. It's probably going to look like the S&P 500, and it does. TNA, weekly chart. These are the small caps. And they're basing nicely. Let's bring up the IWM. TNA is a leveraged product. Let's just take a look at the non-leveraged product, WM. Let's go to the weekly view. Yeah, this is looking really nice. You have a nice base that's built. We're building the right side of the base. We broke out above the 2021 highs, pulled back. Now we're threatening to take out the highs of 2024. Good stuff. Looks like small caps may be breaking out, and that'll be validated, or I shouldn't say validated. The probability of a breakout will increase if yields come in, long-term yields come in. Before we leave the small caps, I want to talk about the mid caps, MDY, because I think this space is working nicely right now. And it's closer to a multi-year high than the small caps. So I really like the mid caps here from a technical perspective. So MDY, bullish. The banks, looking good, but very overbought. But it's clear from the comments out of the White House, they're going to be bank friendly. So they're going to deregulate the banks. And the goal is to get them to lend more to try to bypass the Federal Reserve. Technology, weekly chart. Stalled out here. It just hasn't been able to break out. RSI appears to be rolling over, but momentum as measured by Stokes is rising. Volume to the downside is pretty strong. However, we need to rationalize here a little bit. We're off the lows of the week. So a lot of that volume is due to daily chart buying. So they gapped us down on Monday. We got the reversal. That's turnaround Tuesday. Yesterday's inside day. Today, another inside day. I think this gets resolved up. Semis. I want to be bullish on them. I just can't. I can't. They have really been lagging of late. We were waiting for a breakout. We got the breakout. We even got a continuation move, then they gapped us down back into this trading range. That's a breakout point failure. That's a bull trap. So it's hard to get bullish on the semiconductors when you have a breakdown like this. You know, great consolidation, great breakout, and then it failed. That's what tops are made of. So that hurts confidence. Daily chart. You still have a great W formation forming, good consolidation, just a ton of volatility. Maybe this time next week I'll be more optimistic about them. Right now, not loving them. Software down on the week. So not a great week for tech. LABU. No breakout on a weekly time frame, but I'll tell you, the daily view is looking pretty good. We've been trying to break out and close above. What is this level here? 97.50, let's call it. And we finally did it. So these technicals are firming up here on the biotech stocks. And if the biotechs move up higher and the regional banks, KRE, regional banks, let's bring that up. If they begin to break out, that's going to send the not the semis, the small cap names through the ceiling, because the small cap sector is got a high concentration of regional banks, KRE, and biotechs. Consumer staples. Beautiful breakout this week. A recapture of support. Really good price action. How was volume? Good volume. Daily chart. You know, we had the gap up earlier in the week, but no follow through yet. But they're consolidating gains. Staples are looking pretty good. Emerging markets trying to re-break out. Closed at 56.78. So if we close above this upper band of resistance, basically where we close today or better on the week, this is a buy, especially if the US dollar pulls back. Really good day today. Up 1.37%. Still down on the week. Now, emerging markets with China. Let's bring up the EEM because this is a leveraged product to do a comparison of emerging markets ex-China and with China. EEM has 30% China. So on a weekly time frame, up 0.61% relative to ex-China, which is down. That's a big, big outperformance on the part of the standard emerging market funds, EEM, relative to the ex-China. Energy. Closed back above 90, but still under technical pressure here. Let's go to a daily chart. Sharp pullback, a little bit of a bounce back. Good volume. I'm not quite sure how declining oil prices that the president wants is going to benefit the energy stocks. And energy or oil on the week, these are highly correlated, down 2.59%. On the day, closed up fractionally. I think the U.S. oil producers, they need, I think it's $78, $78 or better oil. They don't want it above 88, but they need it above 78. There's a range that they like. There's a sweet spot They don't want it too expensive. They don't want it too cheap because we're the highest cost producer in the world. The Saudis are cheaper. And the president's been putting the screws to the Saudis to produce more oil or charge less. And I don't know how that helps the oil producers here in the United States. Gasoline prices down on the week. Great to have cheaper gasoline prices. Good stuff there. Natural gas really took it on the chin this week. Now, we were called away, and this is a perfect example of when you need to really respect not just the underlying commodity, but a leveraged product like this is. Now, last week, we bought the shares of Boyle, which puts you long of natural gas, but is a leveraged product. It moves 2 or 3 times the move of natural gas. And we bought it down here. Nobody wanted it. And I sold a covered call up at $55 per share. That got called away from us. And we were wise enough because we still owned a put spread. We were short a put spread, basically put us long, and we still have it. It's going to expire in 16 days. And we're right back down to that strike. If I would have gotten arrogant and said, you know what, the shares got called away from me, I'm just going to open up another tranche of put spreads, or even worse, bought the calls that I had taken away from me and then sold more premium up here, covered calls, I would have gotten my head ripped off. So the only thing that we can manage in trading or in life is our size, right? So how heavily weighted are we towards any one product? And they call natural gas the widowmaker of commodities for a reason. You get too heavy into a natural gas, and you're going to get wiped out eventually. It's just a matter of time. So what was extremely bullish has turned negative. Do I think longer term it's going up? Yeah. I'll just roll the position out if we need to. But the fact that we stayed reasonable allows us to live to play another day. So net was doing very, very well with natural gas, and plan on sticking with it for a while. In fact, we are positioned very, very long of FLNG. We doubled up our position right down here. And the reason is on this trade is that on a monthly time frame, this is why I bought it. You could see how tight these Bollinger Bands were. You could see the long-term consolidation. And as I always like to say, the longer the consolidation, the greater the validation of any breakout. So when you get a multi-year consolidation and you get a breakout, well, that's going to be a heck of a move up higher. So fingers crossed. We're getting higher lows on stochastics, higher lows RSI, and this is yielding still 11.6. We're getting paid about 12.5% yield on this because of where we bought it. So doing well. Would I add more here? No, because I talked earlier about position sizing. I own enough, and plus we're reinvesting dividends into additional shares. So no, we'll add the dividends to additional shares, but I'm not going to add more. Would I initiate a trade here? Absolutely. I would stay small. I would wait for a breakout to close above 26.50, and then I would add more on a rally up and through $28 a share. That's new all-time record highs, clear blue skies. I think it goes up. Now, gold is a monster. Hey, Bob, can you chart the CAD tariffs next week? Canadian dollar? Is that what you mean by CAD, the CAD trade? Just give me a little bit more information on that, okay? All right, so gold, a rip your face off rally this week. We have a pretty sizable position here now. We own the physical and we are short of the futures contracts. Let's go to the daily chart. Again, new all-time record highs. I think that we continue up higher. But just beware of where we're at on a weekly time frame relative to the 3 standard deviation Bollinger Band. It's a little bit frothy on a weekly time frame. I could have said that back here, and I probably did, in March of 2024, and it continued up higher. But just be aware as you're building your position that you may want to do so gradually, dollar cost average in, because you're going to get pullbacks. It's going to happen. Okay, so yes, all right. So that's what I kind of figured. I don't know a lot about these tariffs that are being put in. I hadn't heard that we were going to be putting tariffs. Here, that's what I wanted. So, yeah. So I view it as a contrarian indicator, to be honest with you. When you have a sell-off like this, what you're looking for is a catalyst / and a tell. And let me express what I mean by that. We have been in a downtrend on the Canadian dollar for a very, very long time. And guess where we're at? We're at the lows that found support back in 2016, the same lows as back in 2020. Me, I would be looking to buy the Canadian dollar. And here's what I would be looking for. So let's just say that these tariffs are presumed to be bearish for the Canadian dollar. Okay. But let's play the what if game for a moment. What if these tariffs go into effect and the Canadian dollar in the month of February manages to hold this support level and even closes up? What that tells us is that it's already been priced in. Remember that the election was back here. The Canadian dollar has dropped from a high to a low of about 5.75%. That's a pretty big move for a currency. So is the concern, or are the concerns about a tariff already priced in? And are there sufficient numbers of buyers here to support the Canadian dollar and bet that, yeah, it's probably priced in, we'll work out some sort of a deal, especially once Trudeau is gone, and the tariffs will be gone. So what does that mean? Tariffs gone. I would be looking for tariffs gone, new trade deal, no more Trudeau, and what that means for the Canadian dollar. Me, I'm looking at the Canadian dollar and the tariffs as being the capitulation, the reason why you see a sell-off in the Canadian dollar and probably ultimately buyers moving in, bidding the Canadian dollar up. Therefore, that will be the bottom. And I'm not buying it, but I think that there's a trade to be had long of the Canadian dollar in the coming months, even though there's some bad news coming out there. Bob, I have a question. When you were talking about stochastics under 50 and losing Momo, is that the fast? That's a great question. Is it the fast stochastic, and is it on a daily chart or on a weekly chart? It depends upon the symbol. I'm not sure, Tim, what symbol you're referring to. I would love to answer your question, but I want to respond specifically to the chart you were talking about. If you give me the symbol, I will go back. I'll take a look at it and we'll address it. And I'll tell you exactly why that matters to me, where those stochastics are. They're not just two squiggly lines. They get misused. Stochastics are misused so much. It's ridiculous. People think that the stochastics are primarily used for overbought or oversold. That's nonsense. It's ridiculous. If you listen to books like Technical Analysis for Dummies, where they tell you to short a stock once stocks go above 70, that's bananas. That's so bad to tell people that. It's really malpractice to tell people that. When you get a stock and the stochastics go above 70, that means that it's a strong stock. Momentum. The momentum traders are in control, not shorts. The shorts are getting squeezed, and those stokes could stay overbought for a long period of time. So, or oversold for that matter for a long period of time. So if you want to give me that symbol, I will definitely get back to you. And I use the slow stochastics. The fast stochastics are way too fast. If you're a short-term trader, they're good for you. All right. I'm not a short-term trader. I just don't do that. I'm more of a swing trader, a position trader, longer term. So fast stochastics, I used to try to use them. It's just not, it doesn't fit my style. I don't knock anybody who does if they work for them, but it just doesn't fit my style. He confirmed this evening tariffs for Canada and Mexico on and Mexico. So let's see what the peso is doing as well. The peso is probably a lot stronger than the Canadian dollar. I mean, they at least have a decent economy. Maybe not. All right, so here was the election. What happened? How did I lost my chart. Let's try that again. Okay, let's try that again. Weekly chart. In fact, let's go to a monthly chart. So here is November. Peak to trough down over 6.33% since the election. I would argue that it's quite possibly priced into the price of the currency. And if you take a look at the daily chart, we've stopped going down. We've really just consolidated sideways for the past several weeks. I think it's all priced in. So while the knee-jerk reaction may be down, I think ultimately, and not too far from now, you're going to see a rally in these names because the news is out. The market's going to bet there's going to be a trade deal of some sort. And I'll be honest with you, I think that I'm kind of surprised that he's slapping a tariff on Mexico and Canada because he just negotiated during his last term, renegotiated the NAFTA deal. So I'm not sure the reason why we're placing tariffs on it. We have an agreement with them. Probably they'll go back to the negotiating table, renegotiate that agreement, and the tariffs will be removed. And frankly, once Trudeau is gone, in the case of Canada, Trudeau is just a horrible, horrible puppet. And once he's gone, I think that the Canadian dollar is going to rally on that alone. So the Mexican peso, I think, is probably going to rally as well. But they still have a socialist that's in power down there. You are very welcome. Let me know if you want me to go over. Oh, that was Tim. Tim, let me know if you want me to go over the Stokes. Again, slow stochastics I use. You can use the full stochastics as well, but I prefer the slow. All right, let's do some chart requests and call it a night. WDAY. Donnie, we already did LABU, so I'll refer you back to the earlier version. ANGO. I did LABU about 20 minutes ago. In short, bullish daily time frame on a weekly time frame. We still have yet to close above resistance. WDAY. Okay. Folks, we are using TrendSpider automated technical analysis. We're going to use seasonality tonight. Let's begin with a weekly. Actually, you know what? Monthly chart. On stochastics, I was talking in general, no specific stock. Was wondering if under 50 is the determination line. Yeah. Yeah. So, okay, let's talk about that for a moment. So, I'm going to be coming out in the coming months with a strategy called quadrants, and it's in the preliminary stages right now. But let's use Tesla, for example. And the way I use the stochastic, I use multi. If you ever wonder why TrendSpider and I hooked up, it's because we see eye to eye on a lot of things, and they use multi-time frame analysis. So, as I do, and let's do this. We're on a monthly chart. Let's go down to a weekly chart. Let's bring up a monthly time frame, and let's get rid of everything else. But let's bring up the stochastics. Now, on this chart here, I can bring up the stochastics I'm on a weekly chart. Okay, weekly view. And then I could overlay the monthly stochastics. So the probability of a stock or an ETF moving up higher with both of these in an uptrend is highly probable. Now, when you have stochastics, which are still trending higher on a monthly time frame, yet grinding lower on a weekly time frame, that could pose a problem. And when you get a monthly stochastic trading down along with weakening weekly stochastics, this is what you get. You get a stock that was very strong in an uptrend to one that goes into a nasty downtrend. Why? It's because the longer duration, the longer time frame stochastics are both in a downtrend. Now, to really get back to your question, let me address quadrants coming up. I'll be putting together a, call it an algorithm, if you will, basically being able to punch into a charting system, and it could be TrendSpider, is what are the statistical probabilities of the stock uh, trading up higher, with the determination being the stochastics and how they're trading in tandem. So basically, a score will be applied higher on a bull trade if you have both stochastics and both stochastic weekly and monthly, or depending upon your time frame. As an investor, weekly and monthly time frames both grinding up higher. That gets a tier one, grade A, go for it. If you have monthly stokes, which are flattening out, weekly stokes, which are rolling over, you're going to get a lower grade. So basically breaking up the chart into quadrants. And when I talk about stokes trading down below 50, above 50 is the upper tier. Below 50 is the lower tier. Once you get stokes trading down below 50, rallies tend to fade. It happens all the time. Rallies tend to fade. So you can see stochastics roll over on a time frame, whatever time frame you're trading. But as long as they stay above 50, they can flatten out and hook back up. But 50 is a neutral zone. And if you're closing down below 50, you've lost so much momentum that the probability has now really changed from odds favoring longs to now odds favoring shorts. And if you have both lines, both sets of stokes on a weekly and on a monthly time frame trading down below 50, your odds are clearly to the short side of you're going to make money. If they're both grinding up above 50 on a weekly and monthly time frame, you got to be long. So of course you want to always validate with price, but the probabilities are high that the stock is going to be trading in the general direction of the stochastics. Why? Because it's a momentum indicator. It's not an overbought, oversold indicator. It's not. It just gets bastardized. Okay, workday. I wouldn't short it. I wouldn't buy it. This is a weekly chart. We rallied up and into resistance, and they backed off. I'd be a buyer on a close above 274 per share. We hit it. Sellers moved in. It sold off. Now, momentum is beginning to hook up. I'm not a buyer here. It's just beginning to hook up. They're not established to the upside yet. You're in a trading range at best. If it pulls back down to 248, 249 per share, you may want to nibble, but I wouldn't be aggressive until we break out and close above 274 per share on workday. NUGT. We're long of NUGT. And I think it's a buy. As long as we close out the week above this resistance level here at 46.60 per share, daily chart, great move today, but we're right at resistance. We want to see it close above even 40. I want to see $47 per share, and I would say, okay, let's add more. The caveat, the dollar. I bet you if the dollar did not reverse to close up on the day, we would have closed at the highs of the day on NUGT. When did they rally the dollar? They rallied it right at the end of the day. When did they sell it off? NUGT, right at the lows of the day. Or right at the end of the day, I should say. So you want to see it close about 47 bucks a share. You get that. I think you can get long of NUGT. And again, I'm long. SOXL. I'm not constructive on the semiconductor names right now. They're in show me mode. I went over this earlier. We have a breakdown on a this is a 15-minute time frame. Let's go back to the weekly chart. We have a breakdown on a weekly chart. We're stuck below resistance. You need to see it close on a weekly time frame above 2850, and then I would become interested. Seasonality. February is the second best month out of the year. So if it doesn't do it in February, uh, I don't have a lot of hope for SOXL. It's show me mode for SOXL. ANGO. Angiodynamics. It's stalled out. I mean, it's a good looking chart, but it's stopped going up. You spend too much time trying to break out. Ultimately, you're going to get a pullback because what this chart is telling you is that you have overhead supply above. You have sellers from back here. They want their money back. They're not looking to make money. They've been sitting for many, many months waiting for this stock to come back. Most of the time betting that it wasn't going to come back. Now they finally got their money back and they just went out. So you may be better off waiting for a pullback to this lower band of support because ultimately buyers are going to lose confidence here because they're not making any gains. So if this does not close above 13.25, I would not buy it because I think it's going to come down here to $10.75. This is a rising support level, so it's going to change. But I would wait for a pullback to support or a breakout above 13.30 per share. In fact, even higher than that, 13.50 per share. You are very welcome, Franklin. Yeah, Tim, more to come on that. And for members, that'll be given away free. So sign, but prices will go up when that comes out as well. So sign up. Prices on existing members never go up. When that rolls out, prices for new members will go up. So please take advantage of our 14-day free trial offer. Get TrendSpider for free. Silver and gold level memberships. If you're not ready, that's fine. Get a 35% discount code on TrendSpider using the link below on YouTube, above on Twitter. See you on the other side. Everybody have an awesome night, a great trading day tomorrow, profitable. Be well.